And it's good to see you. I guess we'll just take it piece by piece, starting with inflation. Where are we after this week, do you think?
I think that perhaps we are coming to the peak, Kelly, but we're not sure yet. And until we're sure and until the Fed is sure, I think there's continued risk that rates go up faster than expected. And as a result, we know the impact of that on these glamorous tech stocks and growth stocks. I'm staying away for the moment. So I will probably miss the bottom, but I'm waiting to get a bit more certainty before going back into a lot of these.
So you're not eager to jump back into that trade just yet. And that's interesting because we just heard that it might be kind of a soggy earnings season to get through first. So that brings us to the Fed then. The big question, how important is it for you as an investor about the size of the hike they're likely to do in a week or two?
Well, the approach I'm taking right now, Kelly, is I'm trying to invest rather than trade. And the distinction between the two is really trying to find thematics that I think will survive through an upcoming recession and create value over the much longer term. You know, one of those I'm looking at very closely is in the music space. It's one that I've invested in privately, particularly on the event side. Private equity like Apollo and KKR has been spending huge amounts of money on music libraries and catalogs in recent years. So I'm looking at things like Warner Music, where there is good headline growth in the music sector, 9% CAGR coming up, where there are opportunities for tech to be more infused into that industry. That's the kind of thematic I'm spending my time on, trying to stay away a little bit from the volatility that's more Fed rate related.
And what do you make of the market action this week? I mean, we got a hotter than expected CPI number. We got banks building up loan loss reserves, and yet on the S&P, we're ending about even for the week after a big dip. That seems to me to show that there's a lot of optimism in the market, and I'm not sure that's a great sign.
John, I think there's too much optimism in the market right now. And the reason I say that is I look overseas. We've seen the data and the expectation coming out from China that GDP growth is coming down significantly. We still don't know that supply chain shortages are done. And I think the expression that you use, which was a soggy earnings season, is exactly the right one. So I find the optimism we're seeing in the market today a little bit perplexing. I'm definitely more pessimistic than where it seems to be shaking out this Friday.
How do you read the consumer, which is going to be so important in Q4, given that savings rates are coming down and also consumer credit seems to be coming in? Consumers seem to be a little iffier about putting stuff on a credit card as inflation remains high. What does that say potentially about the type of spending patterns we might see after summer's over? And is all of that priced in to the movement that we've seen this week?
This issue of consumer spending and also the loss rates on some consumer credit, John, is exactly where I'm actually the most nervous. And specifically when we think about what that means as it translates into ad spending, when it comes to consumer products companies looking at their marketing budgets, which tends to be the first thing to get hit when you see a slowdown in consumer sentiment, I don't think we have seen the market yet fully factor in what could happen as real savings continue to be depleted because inflation still is too high, as consumer confidence, despite the decent data today, continues to perhaps be ruffled, and when we start to see labor market data get weaker, because that will absolutely come. I don't think we've seen all the bad news filter through yet, either so far this summer or into the market expectations we're seeing right now.
Shepard Smith here. Thanks for watching CNBC on YouTube.